now, let's invite on the show James Knightley, Chief International Economist at ING. He's here with us. James, thank you very much for joining in. First, let's get chatting about this big, bold, beautiful bill, which is soon going to become a law. Now, the Congressional Budget Office, CBO, is talking about a deficit of $3.4 trillion over the next 10 years. What are the economic implications of this bill for the U.S. economy and even for the world economy?
Yeah, I think there's an important distinction that we've got to make. Firstly, this does add a huge amount of debt to the US government's debt pile, but it does very little. It does next to nothing to actually boost US growth because, in fact, if we look at what the effect is of this extension of the 2017 tax cuts, and that's what the bulk is, this is debt that now has to be acknowledged. But of course, because it's an extension, it means my tax bill doesn't change next year versus this year. Likewise, tens of millions of other Americans will not see a change in their incomes whatsoever. Moreover, what we've got to remember is that there's a huge amount of spending cuts as well. So overall, this bill is actually quite a significant headwind to the US economy in terms of growth. Also, remember, on top of this, what other fiscal initiatives has Donald Trump introduced this year? One is tariffs. That's effectively another tax bill of about $2.8 trillion over the next 10 years. And on top of that, we've got the spending cuts from Elon Musk's Department for Government Efficiency, which is probably running at about $200 billion right now over the next 10 years. So actually, what we've got is an almightily massive debt pile coming through for the US economy to try and get people to lend to it but also it does very little good in terms of supporting US growth.
So in light of that, what do you think the US Fed would do from here on? Because on the one hand, you have, the US economy, the jobs data was fairly stable. At the same time, you have a lot of spending that the government is doing. All these tend to be slightly inflationary. This at a time when everyone is expecting it to go ahead and cut rates. The yields saw a bit of a spike yesterday. What's your own assessment of what the Fed would be doing from here on?
Yeah, I mean, obviously, the Fed are under a lot of pressure. Donald Trump was last week saying that the Fed should cut 200, 300 basis points. And then two of the appointees that Donald Trump nominated back in his first term got in behind him and said, yeah, we could vote for a 25 basis point cut as soon as this month in July. But I think the rest of the committee are far more conservative. Jerome Powell made it quite clear that he thinks that the US economy is in relatively decent shape and that they've got time to assess the impact of the tariffs on inflation. That's what they're really concerned about, because if you remember back in 2021, 2022, the Fed was telling us inflation will be transitory from all of these supply shocks post-COVID. And of course, it wasn't. So the Fed really does want to make sure that it can give the green light to rate cuts. It needs to see what the tariff narrative does. So I think we're going to have to wait another few months. I certainly think they will be cutting before the end of the year, but I just think that to get clear evidence that inflation is not more permanent because of these tariffs means that it may be a December rate cut rather than a September rate cut that the market is currently pricing.
James, hi. Morning. Can't really blame the Fed, can we? Because data out of the US has been so strong, so resilient, including the jobs report last night, right? It's almost like the US is gold-plated right now. Markets are surging. Macro data is looking positive. And so far, corporates have also pretty much held up. We'll see soon enough. On inflation, though, what are you penciling in? What is a baseline tariff case that you're working with? And therefore, what is the pickup in inflation that you're estimating?
Yeah, I think it's what we need to focus on are the month-on-month rates, because if we look in the context of what month-on-month inflation readings do we need to see to deliver 2% year-on-year inflation? It's 0.17. That's the key threshold. If the number comes in at 0.17 month-on-month or below, we're in decent shape. But if it runs hotter than that, we're going to be moving away from 2% year-on-year in terms of the run rate. So that's the key threshold. My worry is that over the next 3-4 months, we're not going to be seeing 0.17s. We're going to be seeing 0.4s, possibly 0.5s. And in that environment, I think the Fed's going to find it very challenging to justify cutting rates, unless, of course, the job market really starts to weaken very precipitously imminently.
James, just getting back to that earlier point about the bill, where you're saying that despite the tax cut, it's not going to result in a fiscal push and boost growth. And on the other hand, you perhaps will be looking at a bit of a death spiral. with debt ballooning. But the bond market in the US appears to be fairly sanguine, just going by the rate on the US 10-year yield. So, I mean, tie that in with us. Shouldn't the bond market be worried and signaling that?
I think it should be very worried. Well, the bond market itself is not necessarily worried. It's about getting the investors to keep lending to the United States government. That's going to be potentially a little bit more challenging because we've got to remember that there's two phases. At the moment, the bond market is focusing on the Fed, focusing on the lower Fed funds rate story. That's, I think, what the key driver is right now. But the medium to longer term story, when the Fed is no longer cutting, when the Fed is potentially going to be hiking rates, I think there's going to be a lot more nervousness about the bond market. What sort of returns you need for the risk that you run? And I would argue that we could well see bond yield come under upward pressure because we're going to see a wall of issuance coming through over the next few years. When you've got foreign investors which own 25% of the bond market, seeing the dollar continuing to weaken, and you've also got the Federal Reserve, which owns 15% of the bond market, still selling. It puts the real onus on domestic investors in the United States to step up, to lend to the US. And as I say, we're just a little bit nervous that we could see medium to longer term a lot more upward pressure on Treasury yields as the government tries to sell this debt.
Okay. All right, James, we will leave it on that note for this morning. Thank you very much for joining in with Perspective. We'll see what the next couple of weeks and days bring. Hopefully more clarity on the tariff front.